Thanks very much, Owen, and for inviting us to be part of the inaugural Rask investor event, and thanks to everyone else for giving up some of your evening to hear us and all the other participants this evening. I think as Doug just told you, whether it's 1.4% or 14% of the average self-managed superannuation fund invested overseas, it's a lot less than it should be. 98% of the world's everything is offshore, whether it's landmass, population, good businesses or wealth. Australia is a tiny portion of the opportunity set, so we're here to tell you about the international equity markets and how we go about finding good businesses and creating good client portfolios from international equities. A big theme that I'd like to leave you with is simplicity, and we think we can make our best decisions for clients if we make them as simple as possible, and which is somewhat unconventional. I think a lot of financial market is geared to make things as complex as possible. So when you think about banks or other financial services organisations, they seem to be inherently complex. They do lots of things, they have lots of investment products, they employ lots of people, and they do that across lots of office locations, which all looks fantastic in a PowerPoint presentation, looks very sophisticated. How can you not do a great job if you've got lots of people in places all around the world? And when it comes to putting portfolios together, oftentimes they own lots of stocks, and they also bet against businesses, which they call shorting stocks. So rather than just owning businesses, they take the opposite position, which again sounds very sophisticated. Oftentimes when it comes to international equities, they throw in something quite different, which is actively managing currency. I might be bullish on the yen or bearish on the Swiss franc, and that sounds very smart as well. And they'll also spend a lot of their time talking to you about what's going to happen next year and beyond, whether it's what's going on in Hong Kong or trade wars or Brexit, UK elections, and all of the other things that we read about in the financial press. So at Aoris, we take the opposite view. We want to make things as simple as possible. We have a single fund, and we'll only ever have one fund. We have a small team of, we're a business of 7 people. We're based in one office location. And when it comes to constructing our investment products, we only own businesses. In fact, we own very few of them. We have a maximum of 15 stocks, and that's how we think we can make our best investment judgments, is by owning fewer businesses. We don't take currency views, although we do recognise that not everybody wants the same thing. We have a fully hedged option and a fully unhedged. So chocolate and vanilla, but we don't blend them. We don't take active views. And lastly, you won't hear us talking about all of the macro externalities that figure heavily in a lot of other manager communication. So let's talk a little bit about some of the other things that we don't do in our quest for simplicity, and one of which is timing markets. You'll read a lot about are we bullish or bearish on markets, or what's going to happen to the S&P next year, or indeed is Europe cheaper than the United States? So one of the tricky things about market timing is, well, frankly, it just doesn't work. And one way of demonstrating this or measuring it is in fact, we've got data that goes back to 1950, and all of the red dots show points in time. In fact, there's 17 points in time where the markets decline by more than 10%. Oftentimes that's called a market correction, and the blue is the S&P along the way. And what you'll see is that those 17 points of correction have happened when the market's been expensively valued, and there's also a good number of instances where the market's been very cheap, where there's also been corrections. So as much as it might be appealing to have people opine on what's going to happen, is the market expensive or not, we don't take those views. We operate portfolios that are largely fully invested. All of our capital in our client portfolio is invested in 15 stocks. Another way people might try and think about, well, is now a good time to be in equities? Are we perhaps coming up against a point of market decline or a correction? And one way they might think about that is, how long has the market been appreciating? Is the market running out of runway, and maybe now's a good time to sit on the sidelines? What we show here is how many months has the market been appreciating before it hits one of those 17 points of market correction. And what you'll see there is that the blue bars vary a great deal in height. There's no consistent pattern between how long a market has been appreciating before the point of market correction. So the key message there is that the time itself, the length of time that a market's been appreciating is not a good signal, not a useful signal at all, if it's trying to inform a decision of is now a good time to be in equities, or are we perhaps heading for a correction? So we don't use whether market valuation or the length of time that a market's been appreciating as useful signals to guide our decisions about how to construct portfolios, even though the whole notion of market timing is a very popular one. Now, another popular notion is, well, I want to be invested in fast-growing countries. Now, surely China's growing faster than the developed world. Maybe India will grow faster than other places. Maybe Europe will return to growth. So GDP should inform my decisions about where I should be invested. Again, the problem is that, as intuitive as that sounds, it simply doesn't work. What we show here is that if over the 10-year period, we've got the rate of GDP growth on the horizontal, the x-axis, and on the y-axis is the rate at which those different share markets have appreciated over that period. And you'll see that as it pertains to the emerging markets, 4 of those 5 emerging markets actually suffered equity market declines over that period. And on the top right, you had a relatively modest performance from China, which was generating economic growth of almost 9% per annum over that 10-year period. So there's a real lack of relationship, even though intuitively you'd think there's going to be a very close one. Now, when we put in the developed markets into that picture, what we find is that the relationship, again, really breaks down. You've had far better share price outcomes in the United States and even in the UK than you have in the fast-growing places like China and India. In fact, India generated economic growth of almost 8% per annum, but over that 10-year period, the share market declined by almost 2/3 over that period of time. So a massive wealth destruction in an economy that was growing strongly. So what do we take from that? Whether you're bullish or bearish on a particular place in the world, it's not a useful signal about where you should be invested. Okay, so let's shift gears. Let's talk about how we invest, recognising that economic growth is not a useful indicator, nor are those market timing signals good ones. So what do we want to do? So when it pertains to international equities, we want to be owners of businesses that become more valuable over time, where the risk of disappointment is low. Now that second part is important. We can dream big dreams. It's very easy to get excited about what could be, and as humans we know that we're wired optimistically, and people tend to overestimate the chances of the good things happening, and they don't sufficiently take into account that there's a wide dispersion of outcomes. So we want businesses where the risk of disappointment is low. So that guides us to a particular type of business. We like businesses that serve other people, other businesses, particularly where they're providing essential products and services to other businesses. Consumers tend to be quite fickle. You can change a shampoo at a whim. You might even change your mobile phone from one manufacturer to another manufacturer, and life pretty much goes on. It's not a decision that's the friction costs are pretty minor, but when it comes to providing essential services to businesses, they tend to be much more stable, durable, profitable relationships. We particularly like those where the business we're interested in, instead of selling to a procurement department, it sells to the users of their product. It might be a chemist, an engineer, a designer, a software engineer, someone on the manufacturing floor. But if you're a business selling directly to your users, it's what we call a technical, direct white coat to white coat relationship. It's a very, very valuable place to be. You're hearing directly from your users what problems they're seeking to solve, how you can provide products that create value for them, and it becomes a very sort of trusted, tight relationship that's a huge barrier to entry and very difficult for someone to come in and unseat you. So that's a real sweet spot for us. We like businesses that have dominant shares in stable markets. It's very easy to get excited about growing markets. One of the features of fast-growing markets, though, is the competitive structure tends to be unstable. Market shares, even in the mobile phone market, can move around quite rapidly. In other markets, electric vehicles is a great example. A few years ago, it might have looked like Tesla would have the market to themselves, but very rapidly, all the other manufacturers are catching up. It's becoming a much more crowded, much more competitive market. So these exciting, fast-growth markets tend to be unstable. We like those more stable, mature, but growing markets. So let's have good businesses are going to generate high returns on capital. That's what makes them a good business. It's what makes them a business that's becoming more valuable, which is what we seek. We like businesses that in tough times remain very profitable. It's what we call our GFC test. We like to think about all the long list of things that can go wrong in the world, and should that replay, or should 2009 replay all over again, we own businesses that prove to be economically resilient. What we don't want is fair weather businesses that fall apart in a time of recession. We like businesses that keep their customers a long time. Retention rates for the businesses we own of 95% and above would be typical, so they're holding the customers on average for more than 20 years. And good businesses grow. We don't like profitable businesses that just tread water. We like those that are able to grow at least in line with the broader economy. So let's shift gears, let's take a look at one. Compass Group is the world's largest contract catering company. They feed more than 20 million people a day through 40,000 restaurants. That would include hospitals, universities, remote mining sites, defence facilities and corporate headquarters. They feed every Google employee in the world. It happens to be their largest customer, and then among many thousands and thousands of other customers. It's a business that, like ours at Aoris, really embraces focus and simplicity. Their customers may be interested in a variety of other services that Compass could provide, but they choose to focus on food. It's what they do well, and it's a business that they absolutely are the strongest player in. It's a business that holds their customers for a very long time. In North America, which is the largest market, more than half of their sales, their retention rate's 97.5%. They're keeping those customers on average for 4 decades. And it's a business that grows comfortably ahead of the broader economy. There's a vast number of these sorts of organisations like hospitals and universities that run their own catering facilities. Compass is able to come in with a great proposition. You concentrate on your core business, outsource the catering facilities to us, and we'll make it cheaper for you and a lot more productive. So it's a very strong proposition. So here's a list of some of their customers. They are Wimbledon. If you get your strawberries and cream at Wimbledon, that comes from a catering facility that Compass run, among many, many other businesses that are their clients. And you can see it's a business that's grown at a good rate over a long period of time. And if you cast your eye to the second blue bar there, 2009, you can see that it was another year of earnings growth. So even right through the GFC, the business was able to continue growing. Let's shift to another business, one that you may be familiar with. Accenture is the world's largest IT consulting and outsourcing company. It's 3/4 of the Fortune 1000 organisations are its customers. 98 of its top 100 customers have been customers for more than 10 years. They're deep, durable relationships. They tend to be relationships at the highest level of the customers. They're not selling to the procurement department. It's the CIO, the board of directors, the CEO are their points of engagement. It's a business that's really evolved in quite an impressive way over the last decade or two. If you think about companies like a Hewlett-Packard, an IBM, they're businesses that have struggled to remain relevant. They continue doing today pretty much what they were doing a decade or so ago. Accenture's done an admirable job of hiring the right talent, buying small businesses that bring new capabilities, such that Accenture's solving today and tomorrow's problems for their clients, rather than those that were relevant 5 or 10 years ago. 10 years ago, their customers might have wanted huge Oracle or SAP implementations and take a whole lot of costs out, big offshoring, outsourcing exercises to India perhaps, or the Philippines. That's still part of their business, but it's not their sweet spot. Their sweet spot is providing far more IP-rich technical services, which might be artificial intelligence, cloud, data security, and so on and so on. And over the last decade, they've grown, exclusive of the acquisitions that they've made, they've grown at a rate twice that of the broader IT market. So it's a company that's, from its positions of strength, have continued to win new businesses and gain market share. And you can see, kind of like Compass, they've generated very strong earnings growth over that last decade. In 2009, they remained highly profitable. They've got a very strong capital structure, which we also pay attention to. They've got about $4 billion of cash on the balance sheet and not a dollar of debt. So over the last 18 months that we've been operating as a business, we've generated very strong returns, significantly ahead of the broader benchmark. So the international equity markets, it's a exciting place for Australian investors. Most people in this room would be underweight that huge opportunity set, but rather than buy the market in aggregate, we think there's a better way of going about it, being very selective, owning a dozen or so businesses like we do, and those that embody those high There's particular characteristics that we seek: high returns on capital, deep, durable, competitive strengths like a Compass Group and Accenture. So here's the full list of stocks we own, and we're very transparent. We show everything we own. In fact, if you take the time tonight or tomorrow to go onto our website, you can click on these icons and they'll tell you a bit about those businesses. In fact, most of them, there's a short company video that really bring to life what they do. So with that, thank you very much. I think we're on time. Do we have time for any questions?
Sure. Stephen, what's the minimum investment?
That's 20,000.
20,000.
Is the unit.
Thank you.
Appointing managers is one thing. I'm always interested in a fund manager when they want to fire one. What's your process and how long does it take for you to say, look, Nike, you're not performing, I'm going to replace you with X?
It's a very good question, and I'm glad you asked it because, and I know we're a little short of time, but people, when they get up on a podium like this, talk most about what they own, what gets into the portfolio. They don't talk enough about what gets a stock out of the portfolio. Look, we describe our process as a common sense investing applied with uncommon discipline, and so hopefully you've got through the last 10 minutes or so the common sense side, but the discipline is really important. Not every business we own is going to pan out as we expect. Some businesses, life becomes more competitive. Sometimes management start to steer the business off course. Sometimes we've just misappraised how good a business was in the first place, and the natural thing is to hold and hope, and to twiddle your thumbs and hope that it all comes right next year. And we try not to do that, so we put a lot of structure and discipline around identifying when things are slowly going off course, and then applying discipline so that we take the right action, which oftentimes is removing a stock from the portfolio. So we've done that on a good number of occasions over the last year, and it's something we really pride ourselves on. So thanks for asking the question. Terrific. Well, thank you very much.